Ladies and gentlemen, good afternoon and a very warm welcome to CFA Society's Greece panel discussion on the hot topic, Shaping a Future Worth Investing in, Climate Change and the Need for Sustainable Finance. I am Violeta Spyropoulou, the Vice President of CFA Society Greece, and it's my great pleasure to chair this panel. CFA Society Greece is the official member of CFA Institute in Greece. CFA Institute is the global association of investment professionals and is considered the thought leader of ESG issues, developing focused research and continuously educating investment professionals. Today, I'm deeply honored to be joined by distinguished speakers who are leading world-class organizations to sustainable finance. In alphabetical order, I would like to welcome Yannis Emiris, the General Manager of Wholesale Banking at Alpha Bank in Greece, Mark Franklin, the President and CEO of CFA Institute USA, Alicia Rubí, a partner at ATTALEA Partners, a leading ESG consultancy firm in Spain, and last but definitely not least, Panos Seretis, head of EMEA ESG in one of the world's leading financial institutions, Bank of America. Thank you all for participating in today's discussion. The COVID-19 outbreak has prompted policymakers all around the world to collectively combat the disruption caused in our society. While tackling the pandemic, we have come to recognize that coordination and resilience are the winning strategy. Just like infectious diseases, climate change could create a shock for the entire world. So a global coordinated response among governments and corporates to create resilient business models would be the most effective response to the climate crisis. Global warming is happening. As global annual greenhouse gas emissions are growing significantly every year, climate change will impact every company and every investor for decades to come. Climate action failure still ranks as the second most likely and most impactful long-term risk after infectious diseases in the World Economic Forum Global Risk Survey published in January 2021. In response, many countries have stepped up their efforts to mitigate climate change risks. EU member states have set a target to reduce greenhouse gas emissions by 55% by 2030 and be carbon neutral by 2050. The US Biden administration has set an objective of 50% reduction by 2030. China will reach net zero carbon emissions by 2060. Global leaders will meet in November 2021 in Glasgow at the United Nations Climate Change Conference to take more decisive actions to tackle climate change and build on the Paris Agreement. Finance professionals will play a critical role in the transition to a clean economy, and this is what our panel discussion will focus on today. BlackRock, the world's largest asset management firm, has placed sustainability at the center of its investment approach. As Larry Fink, chairman and CEO of BlackRock, said in his 2021 annual letter, climate transition presents a historic investment opportunity. Indeed, we saw record inflows into sustainable investments during 2020. Global ESG ETF assets evolved from $45 billion 2 years ago to $260 billion today. This willingness among investors to help build a climate-resilient economy is truly inspiring. This gives us the hope that one of the greatest challenges of humanity, the climate crisis, can be encountered. Without further ado, I would like to hand over to Mark Franklin to put all this into context from her valuable global perspective.
Violeta, thank you very much, and thank you for inviting me here. You rightly pointed out what Larry Fink has marked as a transition to investment opportunity. From our perspective, we see a number of things, including, most importantly, a recognition that the climate in particular is urgent, it's critical, and it's now finally globally understood and embraced by the investment industry. There are three aspects that I think are quite important for this audience. The first is that there's a skills gap as capital allocators and investment managers shift to this new equation of risk, return, and now impact. And this has implications for the way we construct portfolios and meet client needs for value and values. The second aspect is that appropriate and relevant standards and metrics are essential. To properly analyze and incorporate ESG inputs, the current lack of uniform standards for issuers and investment managers is a barrier and needs to be addressed quickly. And finally, I think to pick up on Larry's comment about it being a transition to investment opportunities, this does represent a moment where finance can be a force for good to create an economy that is not only valuable, but sustainable, inclusive, and more equitable. And these opportunities come about once about every 50 to 70 years, and they reflect three conditions: the need for infrastructure, new infrastructure, societal demand for different, and that creates the condition for government and private markets to come together in policy, incentives, and return opportunities to finance and drive that rebuild. And so we see this really as a moment to shift from problems to possibilities.
Thank you, Mark, for your thorough introductory comments, which will set the framework for our today's discussion. Let's kick off the conversation. My first question is, what resources are available to investors to incorporate climate risk analysis into investment models and make sustainable investment decisions? How can investors evaluate ESG risks and specifically climate-related risks? Panos, the floor is yours to share your thoughts and expertise to that question, please.
Thank you very much for the question, Violeta. It's a great honor to be here today with you. I would actually highlight three key points from the investment community and how investors think about ESG and climate. You mentioned the resources. I would say that resources specifically for climate-related risk analysis have actually increased significantly over the last couple of years. Just as a background information, governance always used to be the traditional factor that investors would use across equities and fixed income to evaluate corporates, to evaluate sovereigns. We have seen that over the last couple of years, the environmental factors have significantly increased into the investment considerations. Why is that? It is driven mostly by the regulation. We have seen European Union taking the lead here and actually implementing a series of regulations that promote more disclosure, standardization of green, and actually provide more data and more resources to investors to better consider climate risks. The last point I would like to highlight is that beyond the environmental considerations, we should also keep in mind that we have specific net zero targets for companies, for countries. This happens mostly in Europe. There is a chance that this might happen in other regions as well and follow a similar kind of track. So for that reason, there is a lot of data disclosure that is coming on the back of regulation from corporates. There are a lot of vendors with models and data that provide solutions to clients. And clients, they have also become even more sophisticated over the last couple of years, taking all these environmental considerations significantly into their minds when they consider investing in equities or fixed income.
I couldn't agree more with you, Panos. Indeed, non-financial reporting is a huge challenge to corporations and SFTRs to asset managers. They will need to redesign their business strategy to be socially and environmentally sustainable. The regulatory changes are helpful tools for investors to navigate the transition to allow carbon-resilient economy and take more informed investment decisions. Now, I will turn to Alicia. Alicia, given your specialization in consulting companies regarding ESG performance and climate solutions, could you tell us, please, how companies are incorporating climate change into strategic business decisions and enhance our understanding on SASB disclosures that many companies embrace?
Thank you so much, Violeta, for having me here today to speak on this panel with you at the Delphi Economic Forum. The Sustainability Accounting Standards Board is a nonprofit organization founded to help businesses around the world identify, manage, and report on sustainability topics that matter to investors. SASB standards for each of 77 industries are available free to everyone on the SASB website. Each standard includes descriptions of industry-specific disclosure topics, along with technical measurement protocols for the metrics designed to disclose corporate performance on these topics. These technical protocols are aligned with existing global frameworks, certifications, and regulations. SASB just published last month an updated climate risk technical bulletin, mapping climate-related physical, transition, and regulatory risks to each of the 77 industry standards. Financially material climate-related risk is undeniably present in nearly every industry. Because of this ubiquity, investors cannot diversify away from climate risk. Instead, they must focus on managing it. Keep in mind that each of the climate-related risks can have positive or negative effect on a company's financial condition, operating performance, or cost of capital, and therefore on an investment portfolio's risk-return profile. SASB standards establish a foundational layer of investor-focused disclosure, offering standardized industry metrics to answer the pressing need for comparable, consistent, reliable disclosure of financially material and decision-useful sustainability information to investors. Climate risk is ubiquitous. It is diverse, manifesting differently from one industry to the next. It requires industry-specific disclosures. Today, investors agree that climate risk is inadequately disclosed. SASB's evidence-based standard-setting process identifies the financially material impacts of climate risk to the drivers of corporate valuation and offers quantitative metrics for monitoring corporate performance on climate-related risk.
Thank you, Alicia. You mentioned all the benefits of SASB disclosures. As more and more companies adopt them and common ground for businesses and investors will be created and companies will be more transparent. Mark, CFA Institute is currently working on the global industry standards. The consultation period has ended and a lot of public comments have been issued. Could you walk us through this initiative and tell us when the initial version will be published?
So I'd like to pick up where Alicia left off, which is really how do you take it from the corporate valuation? And we're supporters of SASB because, of course, for the investment industry, the first purpose of it is to create value for those investors who hand over their capital. And that starts with evaluating the companies that we want to analyze for inclusion, the securities and such to build portfolios. So Alicia talked about the SASB standards for corporations. CFA Institute has undertaken to create a investment funds ESG disclosure standards. And it's based really on our long and rich history with performance presentation standards, our GIPS, the Global Investment Performance Standards. And the purpose of it is to address investor needs to be able to evaluate the funds that they're investing in. And that requires transparency and comparability. So we've developed the first global standard for investment funds. It provides a framework for investment managers to disclose the nature and characteristics of their funds, and then for investors to really be able to evaluate those features, purpose, and goals for the fund. And one of the interesting things we found when we were surveying the landscape, and you referred to it, Violeta, in your opening comments, is really around greenwashing. So we found examples of managers not disclosing what the purpose of their funds are, what the benchmarks are, what will or will not be included, the process that they use to build their portfolios. And so our standard really addresses all of these and allows investors to see into the funds and then to be able to compare them across each other to meet their specific needs. So we're very excited about it. You can see the consultation paper in its form now on our website, and the final version will be out in November of this year.
Indeed, ESG standards are a useful tool for asset managers to communicate effectively the ESG features of their products. Now, I would like to turn the focus of our discussion to the banking sectors and banks' pathway to sustainability practices. Yannis, you are leading Wholesale, Treasury, and Wealth Management Department in Alpha Bank, where a major transition is required to be aligned to sustainability practices. Could you walk us through the Greek bank's plan and Alpha Bank's initiatives to this transformation?
Sure. Thank you very much, and thank you for the question. And it's an honor for me to be here today, Violeta. Well, certainly ESG and climate change, which is at its heart, is one of the most important issues that banks today face. And certainly it calls for a comprehensive integration of climate risk considerations in all the decisions of the bank, be them decisions about processes, about credit, about governance and management, and so on. And we would recognize that this calls the attention of various constituencies. I think that Panos mentioned very correctly the regulators that next year are going to have a climate stress test regarding the banks, and also can mobilize prudential macro and micro regulation in order to foster the environmental policy objective. For instance, they can introduce capital credits in order to accelerate green assets introduction. I can give you a few examples about our bank, and this is, I believe, how banks in general would think about. We aspire being a bank that is a 360 ESG, and we have in our toolbox various opportunities. First of all, we use sustainable lending. This is a sector that we believe, not only because we aspire to become a sustainable lender, but also because this is one of the fastest growing sectors in our book. And apparently it appears to be one of the most resilient in terms of credit as well. In terms of, in periods of crisis, it has fared very well, and we didn't have any covenant breaches. So it's a very fast growing segment, when we believe that banks that penetrate this sector fast are going to become market leaders in the future as well. Just a few examples, all the large real estate developments that we finance are lead investments, and especially one of them, the Piraeus Tower that has been discussed in this forum as well, is going one step further and is an all-green building. Also, we are financing some leading waste management factories here in Greece. And we are financing multiple renewable projects. Now, there are challenges in the process. Of course, there are. We need to spot the opportunities that come out of this change. We need to also finance the companies that can benefit from the transition, but also finance those that currently are involved in activities that are brown, but have the management, have the means, and have the vision to transform themselves to an environmentally friendly corporation. Data obviously is lacking. We need to work with companies and agencies in order to improve that, and also with the regulator. And then we need to see what happens at the end of the day with these assets that do not become ESG compliant and are going to be potentially stranded. As far as investments are concerned, we are currently, we have signed the PRI. We become not only ESG, we have adopted ESG, but we are embracing impact investment. We are financing a reforestation initiative that is happening with the money that the funds that we receive from the commissions. And we want to introduce that in Greece. And as far as our own responsible corporate behavior is concerned, we have a new corporate purpose that aligns with sustainability and a new brand identity towards our employees.
Thank you, Yannis. You pointed out very thoroughly Greek banks and Alpha Bank's trajectory to sustainable practices. And I would like to turn to Panos for the same question, please. And in relation also on the stress test in 2022, where the ECB will, climate risk will be included there. Panos, please.
Yeah, thank you, Violeta. This is a great question and very topical. So 4 key points from my end regarding climate stress testing for banks. In terms of timing, as you rightly pointed out, it's going to be next year for the European banks. It's going to be a bit earlier this summer for the UK banks. The second thing is that probably the climate stress test scenarios will penalize the capital ratios of banks. So there is not going to be too much of an upside when you have climate stress test scenarios. The third thing is that the EU taxonomy plays a key role here, defining which sectors are green and which sectors are brown. So depending on the loan sector exposure of the banks, you would get the different results. Some banks that might be greener and some banks that might have more exposure to brown sectors. And the fourth point that I would like to highlight is that this stress test has also some positive effects in the sense that we don't have right now, as Yannis also pointed out, enough disclosure of data of the sector loan exposure of the different banks. This will promote disclosure and standardization of reporting across European banks. And at the same time, when we think about ESG modeling and we think about the environmental scores of banks, a lot of the ESG models out there will actually now try to assess banks based on their own emissions. I am Bank A, I'm based in Athens or I'm based in London, I have these 3 buildings and I emit X, Y, Z of carbon every year. This is not really so relevant going forward. There is going to be much more of a focus from investors on the balance sheet of the banks. Where do they lend? What is their sector loan exposure? And how do they manage transition risks? And that's where the investment focus will actually go going forward for banks and climate assessment.
Insightful view. I'm also sure that banks with superior climate performance will have a comparative advantage to the sector. Now, Alicia, let's turn back to you. From your experience, what is the role that banks can play in tackling climate change?
Thank you, Violeta. That's a good question. The United Nations Environment Program has a finance initiative that works with banks, insurers, and investment managers around the world to create a global sustainable finance sector. Banking regulation varies widely from region to region. The EU and the European Central Bank are global leaders in legislating and regulating sustainable finance. The UN leads the way in sharing knowledge and offering pragmatic guidelines and frameworks to banks globally, no matter their size, geography, or sophistication. The UN Principles of Responsible Banking are an example. The principles are simple. They require alignment of the bank's business strategy to one or more of the Sustainable Development Goals and the Paris Climate Agreement. Banks must adjust their business models and develop realistic strategies. To assist banks with the technical guidance necessary for achieving the objectives agreed in the Paris Agreement, the UN has developed a set of guidelines for climate target setting. These guidelines are free to download on the UN Environment Program Finance Initiative website. They are based on the following key principles. Ambition, to support transition to a net zero economy by 2050. Scope 1, 2, and 3 coverage. 5-year targets with action plans. Real economy impact. governance at the bank's highest executive level, and annual transparency on progress in meeting the bank's own targets. The guidelines require banks to establish an emissions baseline and report the emissions profile of their lending portfolio and investment activities. The guidelines are based upon widely accepted science-based decarbonization scenarios for setting targets that are aligned with the goals of the Paris Agreement. These guidelines are excellent preparation for the regulatory climate stress tests expected in any regulatory jurisdiction.
Very interesting initiatives, Alicia. Now, from the investors' perspectives, Mark, I think you're the most appropriate person, because you are leading CFA Institute, to talk about this. So could you tell us, are investment professionals prepared enough to move ESG integration forward?
The punchline is no. On average, they're not. And we looked at some data that I think would inspire many people in this audience to think about skilling themselves in ESG. We looked at 1 million LinkedIn profiles, and of that, only 8,000 relevant for the investment industry, and about only 8,000 actually list any ESG skills. And then we, at the same time, took a survey of 10,000 job postings, and of that, almost 30% were looking for sustainable or ESG skills. So we know that there's a real supply and demand gap. We worked with the UK Society, CFA Society, who developed an ESG certificate, and we've just launched that globally. That certificate is about 130 hours of preparation. You take a test and it's qualified, and we think that that is a material contribution to educating investment professionals. I was struck by Yannis and Panos's comments from the banking sector, because what we do see is that in the banking sector, they are actually much further ahead because of the regulatory requirements, but also because they have credit and underwriting on their side of the business, and so much more attuned to it. And we need to bring those skills, whether it's the risk mitigation, stranded assets, which were mentioned earlier, the return opportunities, and a longer term focus on the impacts. And that is really going to challenge investment managers, and we're behind the curve on that. So again, there's the ESG certificate, and of course some of the resources that Alicia has talked about to really bring in portfolio managers, asset allocators, and those who are dealing with clients to be much more capable to deal with the go forward world.
I'm afraid we have to run a little. So my next question is about Panos. I'm wondering whether social and governance consideration, the S and G, suffered due to the focus on environment. Could you address that question, please, in less than 1 minute, please?
Absolutely. Again, I will keep it into bullet points, 3 bullet points. So ESG considerations, as everybody on this panel has said, has increased over the last couple of years. Just to name 1 out of 10 global funds that are actually launching are ESG funds today. 7 out of 10 are going to be based in Europe. So significant ESG flows. The second thing, as I mentioned at the beginning of the panel, G used to be always the main consideration for investors across fixed income equities. Environmental considerations have actually come at the same level of importance over the last couple of years. Climate change risks. This is very much driven on the back of the regulation. So G and E equally important. So coming to your question about S, I would say S is going to pick up significantly as of now for 2 reasons. The first one, European Union again is coming up with the social taxonomy next year. So a lot of focus from investors on that. And the second thing, we have also noticed that after COVID, a lot of investors are focusing on the S and the social characteristics of companies. So we see they are already, based on our analysis, a 10% premium for companies that do better on social standards versus the bottom-rated companies.
Thank you. Mark, what's your thought on that question? Very quick. Just one.
I will just say we concur with Panos's comments that social is going to take much more prominence. And again, we're going to start to see data and metrics around that.
And my last question addresses the Recovery and Resilience Fund. Yannis, could you deepen our understanding on the benefits of our arrival to Greece, please?
Well, that's an outsized opportunity, I would say, for Greece, and has significant potential for green transition and the change of the country's operating model. It is going to impact GDP and capital creation in the next few years. It can mobilize capital in the order well exceeding 70 billion, I would say, and have an impact on GDP exceeding 1.5% over the next few years. For us, the banks, it is a challenge. We are very well prepared, but we need to spot the winners, obviously, and help mobilize capital and funding across the capital ladder, not only our own balance sheet, but also capital from the capital markets. This is something that is.
Thank you all for your contribution. I think we had a fruitful conversation. Sustainable investment will absolutely lead us to a resilient economy. However, it's clear to me that only a global effort by all of us can this vital goal of long-term sustainable growth be achieved. Mark, Alicia, Yannis, and Panos, I would like to sincerely thank you for your influential contribution to our panel discussion. Your comments were truly thought-provoking. Mark, Alicia, and Panos, I hope that we will meet in person soon. I would like to thank our audience for their attendance. Keep safe and have a nice evening.
Thank you.
Thank you.
Thank you.